This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome to Chapter 1 of our series, How Investing Really Works, The Complete Picture. In this episode titled, What is Investing? The Fundamental Concept, we'll break down the basics of investing in practical terms, helping you understand what it really means to put your money to work. So, let's dive in. Right now, somewhere on Wall Street, billions are traded in seconds. Yet the core idea behind all that chaos is so simple a 10-year-old could grasp it. In this episode, we'll slow that noise down and uncover what investing actually means for your real life. You've seen that markets look wild on the surface, but rest on a simple idea underneath. Now let's zoom in on what actually turns that idea into real-world results: numbers, time, and your choices. When people talk about the market returning 10% a year, they're pointing to a long, messy history of gains, crashes, recoveries, and everything in between. That 10% isn't a promise. It's an average stitched together from years that looked nothing alike. Some years are a feast, some are a near famine. What matters for you is how those uneven returns interact with your timeline and tolerance for ups and downs. A 30-year-old and a 65-year-old can own the same stock index and be playing completely different games. In this episode, we'll explore how risk, return, and time connect to your actual goals, so you're not just in the market, you're using it on purpose. Most people meet investing through headlines: record highs, painful crashes, hot tips from a friend. That noise makes it feel like a game of prediction or luck. Underneath, though, you're really making a series of quiet trade-offs. Use this dollar now, or let it work for you and your future self. The core question isn't, what will the market do, but what job do I need my money to perform, and by when? From there, everything becomes more concrete. Which tools you might use, how long you give them, and how much uncertainty you're willing to live with along the way. Start with what actually happens to a single dollar. You set it aside, it earns something, and then, this is the crucial step, the earnings also start earning. That second step is compounding, and over long stretches, it quietly overwhelms everything else you do. Consider two savers who each put aside $200 a month into a broad stock index fund and never touch it again. Same contribution, same investment, same long-term average return. The only difference, one starts at 25, the other at 35. By age 65, the 25-year-old has invested $96,000 of their own money. At a reasonable long-run return, that can grow into several $100,000. The 35-year-old invests $72,000, only $24,000 less out of pocket, but ends up with dramatically less. Those extra 10 years don't just add 10 years of growth, they allow every early dollar to compound on itself again and again. That's the quiet math behind why starting small and early isn't motivational fluff. It's a different game entirely from starting big and late. Now put that beside another force, erosion. While your invested dollars are busy trying to grow, inflation is steadily weakening the buying power of anything you leave idle. Historically in the US, a dollar that just sits in cash for decades loses a large chunk of what it can actually buy. So when you commit money for the future, you're not only trying to grow it, you're also racing against that slow drift downward. Then there's the role of uncertainty. No single investment gives you growth, stability, and predictability all at once. To get something, you give something up. Cash gives you stability but little growth. A single stock might offer huge upside, but wild swings and real danger. A mix of many different stocks and bonds spreads your exposure so that no single bad outcome dominates your entire financial life. Think of a balanced portfolio the way a careful chef thinks about seasoning. Any one spice on its own can be overpowering, but the right blend creates something more balanced than the ingredients separately. You're combining things that behave differently on purpose so that the whole experience is smoother than its loudest component. Put together, these forces, growth on top of growth, the drag of inflation, and the way different investments interact, are what you're really choosing between when you decide what to do with each dollar today. Over years, those quiet choices add up to completely different futures. Think about three friends using the same basic principles in very different ways. One is a teacher who wants summers to feel less stressful. She sets up an automatic monthly transfer into a low-cost fund, then simply increases it each year when she gets a raise. Another runs a small bakery. Instead of pulling out every extra dollar, she keeps some profits in the business, better ovens, a second location, accepting more day-to-day uncertainty in exchange for the chance at a much larger payoff later. The third works freelance and has income that swings. He keeps a bigger cash buffer for slow months, then channels any surprise windfalls into long-term investments rather than letting lifestyle creep swallow them. None of them are chasing headlines or trying to be a market genius. They're just deciding, in advance, which parts of their money must be steady, which can be flexible, and which they're willing to let ride for many years so future them has more options than present them. Investing's ripple effects reach far beyond an account balance. As robo-advisors spread, owning a slice of thousands of companies could feel as ordinary as streaming a playlist. Tokenized real estate or art might let you own tiles of buildings or brushstrokes of paintings once reserved for the ultra-rich. At the same time, climate rules and longer lifespans mean your portfolio won't just fund retirement. It may quietly vote on what kind of world and economy you'll grow old in. Your first real decision isn't which fund to pick, it's which future feels worth building toward. Work optional at 55, a sabbatical in 5 years, seeding a child's education, backing causes you care about. Your challenge this week: sketch 3 futures on a scrap of paper and note what each one might cost in today's dollars. That's the map your investing can follow. This was OwlUp, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!